So we'll kick it off. Again, my name is Austin Brown. I want to say thank you to everyone joining us today. Like I said, we covered kind of the wild card round, but to introduce our panelists here, we have the CIO of Global Beta and Justin Lowry. We got 37-year bond market veteran J.R. Regur. Many of you know him from the Regur Report. And we also have, last but not least, Tim Guthrie. He founded Bullseye Investment Management. It's a fee-only investment advisory firm in the business for 30 plus years. Justin, just go ahead and kick us off with a couple minutes of what you're seeing in the markets, and then more specifically, what keeps you up at night.
I don't want to monopolize the time here, but from our perspective, Global Beta, we look at valuations as a huge indicator in terms of probability of forward return. And so obviously it's no secret that markets have been overvalued in large part to the significant monetary policy that's been put in place since COVID started. And then, of course, as everyone has saw today, the Fed has finally announced that they're going to start tapering back on the stimulus programs that they've instituted. So I think, and you kind of saw the behavior work today, where you see a little bit more of a shift to the cyclicals and the value-oriented names. And that's kind of what we expected. And, to your point about keeping us up at night, I mean, these valuation bubbles that have been created in large part because of the extensive monetary stimulus in the market, that's something that we really need to be focused on, especially in the near term, and then outwards for 18, 24 months, particularly as expectations are that the Fed will probably start raising rates maybe late 2022.
Yeah, so great stuff this afternoon, right? Fed kind of hinted at us earlier on, and then gave us what we were hoping to hear. What keeps me up at night is the yields are so low and bond prices are so rich. Bonds have become an asset class that you can't use anymore because of the yields being so low. So, inflation keeps me up at night in particular. The Fed's announcements today, saw some reactions in the market on the long end of the Treasury curve and some softening on long tips. But we've seen billions upon billions of dollars of investor money flowing into Treasury inflation protection funds this year. That tells me, I'm not the only one that's worried about inflation, and I know that I see the prices of things that I'm buying, and the Fed's words, transitory, temporary, transitional. Some economists have used the same words. I could probably come up with another T word or two, but it doesn't feel like it's transitory, or temporary. It feels real to me as an investor, as a spender, as a person in his 60s looking to keep some money as well as spend it. So, you've got all this going on, and bonds being so rich, inflation eroding the yields totally. Inflation is the number one kryptonite for me and for many investors.
Yeah, no, I think, JR, you bring up a good point about yields being so suppressed in large part to what we're talking about. And, this past summer was the first time we really saw junk bonds actually have negative real return. And, I think people have just chalked it up to your point about this is just a transitory situation, very short term. But what if it's not? And I kind of agree with you that there may not be 1970s level inflation, but there's certainly going to be levels of inflation that we haven't seen in a long time. And that's concerning, and I don't think that's being priced into the market right now. And so when you're looking for yield, and when you're thinking about what you're paying for to get that yield, that's a huge thing, and that's something I think is underappreciated right now with investors.
Yeah, I think, stock valuations in places are troubling. And if stock valuations were troubling, bond valuations were insane, right? If you sort of look at your at your yield, divide that into your price and use that as a PE, right, which some people have done. Bond prices were twice as high as stock prices. So I tell you something we've done is tried to look around. Obviously, we haven't owned conventional bonds in well over a year. We did own some REIT bonds earlier in the year. We've been moving out of them recently. We were able to catch some REIT bonds at 88 and 90 in January and December and last October. And now they're at par. So that's been fun. But it's hard. What you have to do is you have to think, I think, unconventionally. You have to look in the nooks and crannies, right? Of the fixed income market. We've also been pretty active in TIPS, and those have had a good year, certainly relative to conventional investment grade corporates and treasuries. And, you know, as investment advisors, investment managers, right, we have to surf the wave that's given us, right? We can say we'd prefer a different wave, right? You know, or we're like farmers, right? We have to farm the climate where weather we're given. We might prefer different weather. But so, you know, earlier in the year when the election went the way it did last year, you know, we liked the idea that possible utilities, energy, oils would come under more scrutiny, more regulation. That would create some opportunities. And so those have been some of our themes. And then just trying to profit from inflation. And that's the typical resource plays, materials, and then of course banks. And then we've also bought some investments that, well, like small and mid cap banks, right? They have just skyrocketed this year, and we still think there's opportunity there.